Hey guys, Andy Harwood here from the Vaz+Harwood team. It's a great day in real estate. So yesterday, the Federal Reserve cut the federal funds rate another 0.25%. And we get a lot of questions whenever there's a Fed rate cut, and we've had a few this year. We get a lot of questions from our clients about what does this mean for mortgages? Does it mean mortgages are going to be cheaper now? If I've applied for a mortgage, am I going to get a better rate now? All of this kind of thing. So one of the things that I always like to point out, make sure people understand, is that the Federal Reserve Board does not cut or increase mortgage rates. These two are connected, but they don't directly set mortgage rates. Okay, so people think that when there's a Fed rate cut, that the mortgage rates are automatically going to go down, and usually it does not work that way in a direct correlation. So thing one here is that what the Fed is actually cutting is the federal funds rate. This is the rate that banks use to lend money to each other. The Fed regulates that. And mortgage and other markets follow that because that's baked into the overall market. So they cut their rate, and the mortgage rates follow, but they don't always follow. Often it's baked into it already because they have a good idea that the Fed is going to do this. So often the downward trend in mortgage rates, you're already seeing it on the front end. It's already baked into the market by the time the Fed makes the big announcement. Okay, so let me just share my screen really quick, and you can see kind of current typical mortgage rates and a graph for about the last year. Mortgage rates are on the way down, which we would expect because the Fed has made a few rate cuts this year, especially. So it's kind of good news for mortgages overall. We're seeing lower rates, and this is another, I guess, good sign for mortgages. We always hope, we always want our clients to have good mortgage rates. But I always want to emphasize, too, that we have to be careful because the good rates could come with a penalty in some other areas that can affect your household expenses. And it's good just to keep this in mind. So when you're overjoyed that you hear the Fed's cut rates again and mortgages might get more affordable, just to understand a couple of things here. The Fed is they're trying to balance two things. They have two jobs. One is they want to keep unemployment low as possible. And the other thing is they want to keep inflation as low as possible. So one of the interesting things about this particular rate cut was that the Fed was not unanimous on it. There were a couple of people who wanted to do some different things. One wanted to increase it more, I think half a percentage point, and at least one didn't want to make a cut at all. And so we've got some things in the economy that are not crystal clear right now, and this is affecting everybody. So if we're talking about inflation, and we all want inflation to be lower, the Fed is trying to get inflation to 2%. That's their goal. It's not 2%, it's more like 4% right now, but it's still massively better than like in 2022. And the reason it was so high back then is because during the pandemic, the federal government dumped so much money into the economy that it increased inflation drastically. And also the Fed kept their rate at zero for a long time, the federal funds rate, and then they only increased it started to in 2022. That had a big effect on the whole mortgage and real estate industry for sure. When we saw those mortgages go up a lot during that time, but it had to catch up. And so now we're seeing a balancing off of that, but inflation has started to go up again. And so cutting the interest rate again, dumping more money into the economy, they're worried that this could have the wrong effect on inflation. But then the other thing that they're concerned about is unemployment, and unemployment has started to tick up a little bit more too. Now, why is unemployment going up? There could be a few things, including slowing job growth. Some companies are doing some layoffs. There could be some AI effects that are starting to seep in here. And there could be also some long-term unemployment that's showing up in the numbers. So that's all well and good. Uh, what does it have? What does it have to do with you if you're thinking about getting a mortgage or buying a house? One of the things, another important thing I always want our buyers to understand is that the historical average of mortgage rates is now about 7.7%. So anything under about 7.5, 7.75% is relatively cheap money. Please keep this in mind. The likelihood that we're going to see 3% interest rates on mortgages again is not only low, I hope we don't see it, because it had massive inflationary effects that are now affecting all kinds of other expenses in the economy and increasing the cost of living. And one of the number one things I hear from our customers who want to buy a house, especially at the entry level, is maybe they can afford the mortgage, but it's just the overall cost of living that's so challenging. So just remember that this is a balance, and a 6 point something mortgage is not bad. Historically speaking, it's not a bad deal at all. So I hope this is helpful, and if you have any questions about real estate, shoot them my way. Thank you.